For Insight, let's go to our featured guest of the morning. He's Greg Taylor, Chief Investment Officer at Purpose Investments. Greg, thanks for coming in.
Thank you for having me.
There's lots to talk about here. Let's jump in. You believe that the next meeting of the Fed is in fact live, and that the chances of another Fed rate increase are perhaps more real than they were before the Bank of Canada made its move yesterday.
Yeah, the central bank governors in the U.S. and other Fed speakers have, in the last few weeks, been very adamant saying that they're on pause right now and trying to signal a pause. And messaging has been very important for this Fed. But I think they can't really ignore that inflation hasn't gone away. The stock market in the U.S. is basically back to highs. So if they're going to signal another hike, why don't you do it now? And I think that's something that's more on the table than I think the bond market is pricing in. The bond market is pricing in no hike for June and then a hike in July. And to me, it doesn't make sense to wait. They might as well do it. And I think when you look at what the Bank of Canada and the Reserve Bank of Australia did in the last week, I think it signals that central banks globally are looking at continuing this fight against inflation.
And crucially, we will get U.S. consumer price index numbers the day before the Fed makes this decision. How influential could that be? I'll tell viewers in just a second what the consensus call is. Economists polled by Bloomberg believe that U.S. inflation or the consumer price index growth will come in at an annualized pace of 4.2% in May. That would be a substantial drop-off from April's 4.9% number.
It is, and that's a good news story. So what we've got is inflation did seem to peak out last summer when we had those 8 to 9 readings, and we pulled back to the 4. But the target's still 2, and normally central bankers have their policy 2% higher than the rate of CPI. So we're still well off of those targets, and I think the battle's well from over. And when you're looking at some of the economic data, things are still going pretty well. So if your mandate is to battle inflation, I don't think it should be a surprise to see central bankers continue their hiking method right now. They could go with a bit of a pause, and maybe they will follow the Bank of Canada's path. The Bank of Canada did pause a few meetings ago, and then they've been waiting and data dependent, and the data didn't come in their favor. So we could see a pause in June, but it definitely means that hikes are still on the table for the balance of the year.
One of the Bank of Canada's options yesterday was a so-called hawkish pause, but to point pretty bluntly to a likely increase in July. Why do you think the Bank of Canada did not pursue that path?
Well, I think it's also something that when it's out there, might as well just do it. They've been basically the bond market and everyone's expecting that they would hike in July. So instead of just waiting for July and maybe have people rush in and put mortgages on and say, well, maybe they're not going to do it, and then maybe just get it on the table and see what happens. It could also be from a currency point of view that if you do think the Fed is going to do something, get ahead of it and try and maintain the Canadian dollar.
And what does the Fed's the possibility of a hike from the Fed mean to equity markets? Equity markets were very much warming up to this idea of a pause from the Fed, and perhaps in the most optimistic scenario, an end to the Fed rate hikes.
Well, I think it's adding a degree of risk to the equity markets, and looking at the S&P 500 and the Nasdaq in the U.S., that's become a really very dangerous and risky index because it's become so concentrated. Going back to the days of the dot-com crisis, we haven't seen levels of this concentration from the top 5 names. And all of those top 5 names are technology stocks, which are incredibly tied to interest rate policies. So the markets did get a sense that coming out of the regional bank crisis, that rates were going to stay lower for longer, or the pause was going to be here. And I think now that the banks crisis has seemed to stabilize, that I think it's a live meeting again, potential for more hikes, and that could be a surprise for markets, and markets don't like being surprised.
And we'll talk in our next segment about Greg's thoughts on the tech stocks and where he thinks investors might go in as alternatives to the tech sector. Let's talk about what this means to Canadian borrowers and perhaps the Canadian real estate market. And by this, I mean the Bank of Canada's hike yesterday.
Well, it's definitely mandated and looking at going after the borrowers, that there's been too much risk in the system. There's still a high degree of lending. And then when you look at some of the housing data that came out in the last few weeks, it's been pretty strong. And I think the mandate of the Bank of Canada is to try and clamp down some of this speculative excess and trying to take prices down. And we haven't really seen that yet. So I think that's why they went yesterday with the hike. And it probably means the next meeting's live, too, for the Bank of Canada, because they do need to be data dependent and see the data come down. So it could be something that will take a bit of the wind out of the housing market, but they also don't want to play the balancing act. They don't want to crash the economy. They don't want to have unemployment spike, and they don't want to blow up the housing market. So it's walking the line of getting prices back under control, so it's better for everyone, but not destroying the economy at the same time.
Do you believe the Bank of Canada can engineer the so-called soft landing, a no recession scenario?
Oh, well, it's one of these things that everyone hopes for, and we'll see if they can actually do it. There's a lot of moving parts, and Canada being a smaller economy dependent on international international trade, there's even more moving parts. So I think that depends if the U.S. economy can engineer a soft landing, and if they can, then there's probably a decent chance we do have one. And things are going pretty well right now, so it's really get that inflation number down.
Let's finish with what brief comments on what this means to the Canadian banks. They boosted their prime lending rates yesterday, as we would expect, in lockstep with the Bank of Canada.
Well, it's something the Canadian banks have to do, but it's probably going to, again, slow down some lending for the banks. And the banks just went through a quarterly reporting season that wasn't really that strong. So you have to wonder if this is going to be good for the banks or not. They have to follow along with the policy and interest rates, but it's probably going to slow down demand growth for loans. And if there's any risk to the housing market, that's a concern for them.